Good evening. Can anyone hear me?
Yes, I can hear you, sir. Good evening.
So, can we continue? I don't know if we have any member here.
We can continue. It's being recorded, so we can continue, and the time is already going.
Okay, then that's fine. I'm trying to open the question itself. Okay. All right. Good evening, everyone. Sorry, we are starting a bit late than expected. So, I'm trying to share my screen now. I believe everyone can see my screen. Please confirm that you can see my screen.
Yes.
Okay. All right. Welcome again to the study challenge live class for SFM, where we're going to be looking at some basic questions and we'll be providing answers to them as within the space of an hour. And we're going to be looking at some topics that we have earmarked for the purpose of the exam. I'm sure by now we are not new to ICAN exams, and for you to have gotten to this stage, I want to solely believe that you know the techniques of how ICAN acts their exam. So what we've done basically in this 60-day study challenge is to strategically look at some topics that we know that students cannot do without in the forthcoming exams, and that we are so certain that no, not that we are so certain, permit me for that use of words, that we are suggesting that ICAN may want to test, either due to the fact that it's been a while they tested such questions, or probably because we have also come to understand a pattern by which they ask their questions. So we had just about 5 questions here to look at, but because of the technicality that is involved in explaining SFM, we might not be able to cover all the questions, but as much as we are able to do in these few minutes, we will touch them. We will touch them. So quickly, let us start. It is generally believed by research It is generally believed, as suggested by research, that most markets have either weak form or semi-strong form efficiency. However, some unique factors may impact on the efficiency of the market in either of this form discussed. So basically, what ICANN is asking us to discuss here is the weak form and strong form efficiency. And because because SFM is purely calculation, I can at times I can at times try to um, bring in some written aspects written aspects such that it become a mix of both, and as a result of that we cannot say because there is a written aspect and we want to look over it, no, so that we don't shoot ourselves at the foot. So let's look at the solution. to the question. Coming down here, we said the following are factors. They had said that we should look at a factor, some factors that may actually affect the strong form and the semi form of efficiency in a capital market. So we said that the following are factors that may affect the efficiency of the capital market. Number one is the availability, is the marketability and liquidity of shares. That is, the greater the volume of shares traded, the more opportunity there is to reflect any information, any new information in the share price. Of course, when there's when there's liquidity in the shares, in the market, it gives opportunity for shareholders to reveal information, to talk about more information of the on the share price. But when the price of the share is static, that is, maybe in the course of declaring the dividend, a company has determined how much the strike price of its share, and as a result of that, there is nothing that could be done. So there is little or no information that can be given in the market as to that. Next one is availability of information. So not all information can be available to all investors at the same time. Shares which are traded more by professional dealers are more likely to reflect full information, as they can afford to pay for better monitoring system. So as they can, sorry, a call just came in. I had to hang up on that. Solution to, so let's look at number two. Please, like I said, please feel free to stop me at any point to ask your question. Feel free to stop me if you have any question to ask. Please ask me. The next question says Boko Limited and Aram Limited are relatively small companies. At a recent joint board meetings, sorry, I'm trying to. At a recent joint board meeting of the two companies, a decision was taken to merge so that they can compete more effectively with their large competitors. It was agreed that a scheme of amalgamation be drawn up based on the following agreed figures and valuation. So let's see, we have figures, we have under net assets, we have net assets, we have ordinary shares of ₦1 each, we have the 8% preference share. Boko does not have that, but Aram has. We have the reserves, we have the 10% loan stock, and of course, we have other historical earnings for year one, year two, year three, year four, and year five. And then we have the price earnings ratio for the purpose of amalgamation. So now we are being asked that we should compute the values, that will be placed on the ordinary share for amalgamation purpose using price earnings ratio. We also have to compute the implied net dividend yield for each company, and we should compute the earnings per share for each company. So now we should also comment on our observation in respect of the valuation method adopted in the to the past performance of the two companies. So really, in this case, we're looking at performance. We're looking at the valuation. We're looking at stock valuation. We're looking at amalgamation. So this question is all encompassing. It looks at amalgamation. It looks at a bit of merger and acquisition inclusive, and it looks at the value proposition of the company. So let's see how we aim to attempt it. And of course, we also need to understand that whenever we see questions like this, we see first 1 year previous, 2 years, 3 years, 4 years, up until 5 years, we should expect that there may most likely be a growth in dividend, and of course, our growth formula, Modigliani and Miller, should come to mind. Moving on from there, now, in order to solve the question, we first of all need to analyze the value of shares for amalgamation. The value of shares for amalgamation is usually derived as price earning ratio multiplied by the earnings per share. Price earnings ratio multiplied by earnings per share. Now, our price earnings ratio can be gotten by saying earnings per share, which is equity earnings divided by ordinary share. Now, equity earnings, what we've really done here is to say that equity earnings divided by ordinary shares is equal to valuation per share divided by 15, because you might be wondering where that 15 came from, but I think it's just in the course of arranging the material that the division there was not included. It should be divided by 15, and if you do your mathematics well, you are going to have the value of shares, which is 6 naira, which is uh yes, 6 naira to 1 share. 6 naira to 1 share. So hence the total value of shares in the company would now be what? Market price per share multiplied by the ordinary share that you want to buy. So for Boku, it was 7 naira 50 kobo, but it's for Aram, like we had said, these two companies are trying to come together to become one. So we need to look at their valuation individually before, so we know what they are bringing to the table. We know what they are contributing. We know what value are they adding on board before we can now consolidate them or amalgamate them, whichever way you want to call it. So going on from there, what we do is that we try to look at the value of shares in each of the company. So for the Boko already has 1.8 million unit of shares, and we have established that the value of shares for Boko is 7 naira 50 kobo. If you do the mathematics, that will give you the 13.5. And for Aram, we have it at 6 naira for 1 million shares. So that will give us 6 million naira. So that's that for the A part of the question. So moving up, the B part of the question says calculate implied net dividend yield. Implied net dividend yield of for each company. Implied net dividend yield for each company. So the net dividend yield, that is the dividend divided by the total market. Dividend divided by the total market. So for Boko now, we need to calculate what the dividend is and what the total market is. And we have established, we are in the A part, in the computation, we've been able to establish the total market, or what we can refer to as the total value of shares for both companies. So it is now to look at the dividend. So if you scroll up, we were given dividend at the first year, and that's what we had made use of to say that dividend divided by the total share value that we have gotten when we were calculating the value of shares that each company is bringing on board. So by calculating that, the implied dividend for Boko is 1%, while for Aram is 2%. So assume 20% and 30% dividend payout. Payout will be maintained in a foreseeable future for Boko and Aram Limited respectively. So now, earnings per share for Boko and of course for Aram. Last year earnings for Boko is 600,000 and for Aram is 380. And of course, we have the total number of shares just similar to the one that we used in the A part. Total number of shares for Boko is 1.8, while for Aram is 1 million. If we do the calculation very well, that gives us 33.3 kobo and 38 kobo respectively. So now that takes us to the forecast earnings. Don't forget all these figures that we're looking at, they are all given in the question. So please don't be at loss. So if you look at the question, you will see the forecast earnings that they have given us. What we just want to dictate is that we want to know what will be the dividend per share. So, and that is why we are dividing them by the ordinary shares that the business has in stock. So that is by way of that. Does the question has a D part? Let me check. Okay, I think there's a part here that says comment on your observation in respect of the valuation. Comment on your observation in respect of the valuation method adopted in relation to the past performance of the two companies. What is your observation in respect of the valuation that you have adopted in relation to past performance of both companies? So in terms of our observations, let's go down. So earnings per share of XYZ Limited is based on forecasted maintainable earnings. And of course, a higher valuation has been placed on ABC Limited in via the price earnings ratio because apparently of its low gearing position and therefore its borrowing potential, and because of its better earnings record, both in terms of growth and consistency. So if we look at what we have calculated now, we will see that the earnings of Boko and that of Aram, their earnings is a bit higher. The earnings of Aram, sorry, is a bit higher than that of Boko. So it shows that Aram is bringing more to the table than Boko himself. So, and it is on that basis, this is what Boko will look at in order to consider if the company will accept the amalgamation, the joining together of Aram. They will look at it, what are they bringing on board. So but with this computation now, we can see that Aram is bringing something that is a bit higher, slightly higher to what Boko has already in store, and as a result of that, the partnership can work. I don't know if anyone has any question thus far before we move on. Question 3. A share currently selling for 65 naira. The company has decided to pay dividend of 2 naira 50 kobo per share at the end of the year. It is reasonably estimated that the share will trade for 78 naira at the end of the year, assuming the dividend and share price and forecast are accurate, would you buy the shares to hold for 1 year, given that your expected required rate of return is 12%? Given that the current price and dividend, what would the price have to be at the end of the year to justify the purchase of the share today, assuming your required rate of return is 15%? Your required rate of return is 15%. First, it will be essential for you to even understand the requirements of the question. He said the company is selling for 65 naira and has decided to pay dividend of 2 naira 50 kobo at the end of the year. It is reasonable that the share will trade for 78 naira. So that means there is a gain on the share. There is a gain, even despite the fact that they will pay dividend, there is still a gain on the share. So assuming that the dividend and share price and forecast are accurate, would you buy the share for 1 year, given that your expected required rate of returns is 12%? So if they give you, so this is basically a decision making question. And if you have some questions like this, I expect that you look at first is that if I buy the share to hold for 1 year, what will be my returns? So in 1 year's time, how much would the share as worth? If if based on your calculation, you derive that the share will worth less due to one reason or the other, maybe you have done a market research, or maybe you've done a market survey, or maybe you've read economic news, and you are, from what you have seen, you have been able to ascertain that the share of that company is likely to reduce in the unforeseeable future, So in that case, your recommendation or decision will not be the same as with other management. It will be different in a way because you might be seeing what we are not seeing. So first of all, in order to make a decision, you first of all need to calculate what the share price will be in a year's time compared to what it is now, and see if there is going to be a profit eventually. So let's move down. So given this formula now, the share valuation model for 1 year holding period is D1 divided by 1 plus K, which is equity, plus S divided by 1 plus K raised to power 1. Hence, given D as 2.5. So this one is just using formula to divine the missing figures. This one is just making use of formulas to define the missing figures. So based on this calculation now, we are saying since the current price of 65 naira is lower than the intrinsic value is also known as the future value of the shares. So what we have done here is to calculate what will be the future value of the shares in a year's time. In a year's time, what's the value of the share? So if you're able to get that value, it will help us in a way, it will help us to ascertain if we are currently selling at loss, or if we should just hold on to what we have at hand. Or if we should just hold on to what we currently have at hand. So, but based on what we've calculated now, we've seen that our intrinsic value is higher. So, and what it means is that the share is being underpriced. So, once we have known that, what we can do is to bid for more. So, if we bid for more, so let's assume that the intrinsic value was 71.87, and the price at which they are and what they are pricing the share currently is say 100 naira. we know that that is higher than the intrinsic value, and as a result of that, we can go ahead to trade the shares. So what this will help you to do is that even in your organization, you want to make a decision, you have to consider the impact of that decision. Look at the impact, look at the responsibility. What will it look like at the end of the day if we are incurring, if are we going to be shouldering a whole lot of responsibility for incurring that particular cost. So these are the things that is expected that a finance professional will consider before making an accurate decision. So I want to believe nobody has any question thus far before I continue. Okay, I'll continue. Now, to determine the selling price of at the end of the year, which will result in an intrinsic value of 65 naira. Now, 65 is equal to 2.50 divided by, so all these ones, they are still repeating the formulas that I have initially explained. They are looking at the formula that I initially explained and how it is going to work. So we are saying that this implies that a selling price of 72.75 at the end of the year will justify the purchase of the shares at the current price of 65 naira. So what they did here is to look at it. Now, for the company that is buying, we want to look at it. Does it really make sense for us to buy? So it makes sense for them to buy, because if they don't buy now, what that means is that, excuse me, what that means is that in a year's time, they are going to be buying at 72.25, and that is a far cry. You can imagine if they want to buy 1 million shares, you can imagine what the loss would have amounted to had it been they have bought it now. So this calculation is just majorly to advise the shareholders on what should they do at the moment. Should they just go ahead and buy? And based on this, I think it just makes sense for them to buy. Why? Because in a year's time, the value of the shares would have greatly increased, and they won't be able to get it for such an amount any longer. So let's quickly look at question 4. Question 4. Ejalonibu is a manufacturing company located in the industrial area of Lagos State, Nigeria. The company is known for the manufacture of pass kits, a learning tools by professional accounting students for passing their exams. The company has a total current value of 100 million. Excuse me. They have a total current value of 100 million, consisting of 80 million equity and 20 million of debt capital. The cost of equity is 10%, and the pre-tax cost of debt capital is about 6%. The rate of tax on company's profit is 25%. So the company proposed to borrow an additional 20 million naira of debt capital and use the money to buy back and cancel 20 million of its equity. So let me just try and break down what that place is trying to say. So the cost of equity is 10%, and the pre-tax cost of the debt is 6%. The tax on company rate. So now we know that once you see 25% like this, you know that you don't apply the normal CIT rate of 30%. We have to come here and use specifically what percentage they are. In this case, they have said the company that the tax should be what? The company should be taxed at 25%. So the company proposed to borrow an additional 20 million. Don't forget that they already had a loan of 20 million debt capital to be paid back. They want to borrow an additional 20 make it 40 and use the money to buy back and cancel 20 million naira of its equity. So now what they are saying is that now they have 20 already as a debt. They want to borrow 20 more. So the 20 they are borrowing now, they are using it to offset the 20 that they had borrowed initially. What that one will do for them is that the interest will stop and it will now start counting. So they would have been able to stop the interest from the period, especially when the interest is compounded, especially when the interest is compounded. So if they use this strategy, what it does to them is that it helps them to offset, to stop the interest on the period facility, and the interest can be transferred or rolled over to this new facility, and of course the burden will not be as much as what they would have paid. So yeah, it's a finance strategy that they can adopt, and it won't be a bad idea. So now, assuming, so according to Modigliani and Miller, we are saying that what will be the following values for the company as its new level of gearing? Okay, we are looking at it one in internal value, in total value divided, excuse me, okay, its total value divided into a value for the equity and a value for the debt capital. The second one is WACC. The third one is cost of equity capital. Okay, so going down to the question now, we say that the first step is to consider the value of the company at the new level of gearing. So the company will be replacing 20 million of equity with 20 million debt capital. So in the new gearing structure, debt capital will increase, right? Because instead of 20, because the 20 that has gone out is now coming in back. So for receivables, they have 20 million naira cash to keep, and of course he is passing away with 20 million. He is passing away with what he's buying. I mean, he won't have the funds with him again because he has used the funds to offset the previous 20 million that was already existing. So we have the current value of the GL company, which is 100 million, consisting of 80 equity and 20 capital, 20 debt. We can calculate the cost of similar company that is all equity financed. So value of growth is equal to VU plus the debt multiplied by tax. VU means equity. So value of growth is 100 million, and of course VU plus the 20 million, that is the debt that we're talking about, and the tax rate, like I mentioned, is 25%. That you have to be careful so that you don't use the applicable tax rate of 30%. So if you do the calculation, you have what we have 95 million naira as the value of equity. Please feel free to stop me and ask your question. So for step two, after you've acquired that, then is to look at the value of the company at the new level of gearing. What is the value of the company at the new level of gearing? So the company will be replacing 20 million of equity. with 20 million of debt capital. So in the new gearing structure, debt capital will increase. So the value of the debt will now be the 20 million that was initially existing plus the 20 million that was now borrowed in order for you to offset the existing debt. So we can calculate the total cost of the company as its new gearing level using the same Modigliani and Miller formula. So the VG plus the VG equal to VU minus DT. In fact, I think it used to be okay because the growth accumulative, because it used to be D open bracket 1 minus T. So, but I said that if once the growth is cumulative, there needs to be an adjustment to the growth rate. So I'm sure that's the reason why we have to. So we didn't use the minus one, we just moved straight. That's why we have to call this formula on my screen dt instead of d into bracket 1 minus t. So if you do this calculation very well, your value of equity still remains at 65 million. So now let's look at the WACC. The WACC. So we look at the source of finance, the market value, and everything, rate and market value multiplied by rate. So this is just to show it in a bit more detailed and explanatory form of how to calculate the WACC itself. So the equity now is 80 million, the debt is 20 million. Addition of both together give us 100 million. The cost, now we have two cost of capital, and I think so. Please pardon me, I'm trying to look for something. Aha, okay. So now the cost here is that the cost for equity is 10%. That's when we're looking at it, we said 10% equity, while the one for debt was 4.5%. So and that's what gave us 0.045. So the cost, which is market value, so the value of the shares now is 80 multiplied by 0.1 and 20 multiplied by 0.045, addition which will give you 8.9. So the cost of capital, which is the weighted average cost of capital, will now be 8.9%. So we can use Modigliani and Miller formula for WACC to compute what the WACC would be in a similar company. So the WACC of a similar unjet company. So this is just to give the formula. WACC growth is equal to WACC on GED, open bracket 1 minus value of debts and tax divided by the value of the equity. Is usually it should be VE, not VF. It should be VE. So when you do that, your WACC for J company now comes to 0.09368. So WACC of the company at the new level of gearing. So having established that the WACC in an all equity company, we can now use same formula to calculate the WACC in the company as its new level of gearing. So with 40 million debt and 65 million of equity, the value of equity and debt capital at the new level of gearing were calculated as. So we have the calculation WACC geared is equal to WACC on geared 1 minus value of debts into tax minus um value of ungeared, which is 40, into 1 minus 40 open bracket 0.25, then divided by 1.05. So calculating it well, the WACC for growth becomes 0.085, or what we can refer to as 8.5%. So These were just the processes, the analysis, the rough work that was done in order to arrive at that answer. So hold on. So I want us to, in the next few minutes, I want us to look at number 5, which is the last one for this diet. So, but before that, do I have more people? Oh no. So let's move on to the final one quickly because of my time. Babayaro PLC. Babayaro PLC has been experiencing difficult trading conditions over the past few years. In the current year, net earnings are likely to be 20 million, which will be justified to pay a dividend of 1 naira per share. The earnings are the earnings and dividend for the company over the past 5 years are shown below. So in fact, this is even, yeah, this is for 5 years, 2014 to 2004 to 2008. That's actually 5 years. So there are 20 million ordinary shares in issue, majority of which are owned by private investors. There is no depth in the capital structure. Members of the board of directors are considering a number of strategies for the company, some of which will have an impact on the company's future dividend policy. So the company shareholders require a return of 15% on their investment, and the following 4 dividend payment options are being proposed or are being considered. 1. Pay out all earnings as dividend. Pay a dividend of 50% out of earnings and retain the remaining 50% for future investment. Pay a dividend of 25% out of earnings and retain the remaining 75% for future investment. And the last one is to retain all earnings. Retain all earnings for a aggressive expansion programmed and pay no dividend at all. So these are 4 major options that the directors are considering, and then they are looking at exploring. Okay. And these are the options they are looking at exploring. So the directors have not been able to agree on any of the 4 options. Some of them prefer option 1 because they believe that doing anything else would have an adverse effect on the share price. Others prefer either option 2 or option 3 because the company has identified some good investment opportunities, and they believe that one of these options would be in the best long-term interest for the shareholders. So an adventurous minority favors option 4 and think that the option will allow the company to take over a relatively small but vibrant competitors. In light of the above exposition, you are required to 1. Discuss the company's dividend policy between 2004 and 2008 and its possible consequences on earnings. You are to advise the board of Babayaro PLC on the share price that which would be expected immediately following the announcement of their decision if they pursue each of the 4 options. Using an appropriate valuation model, notes make all necessary assumptions. This looks like a very detailed question, and I just have to take my time to read them so that we can so that we can probably just adjust and follow through. So hold on, let me see where the solution is starting. Okay, so let's look at the solution quickly. Now, we have 5 years here, 2004 to 2008. We have the net earnings. The net dividend for 2004 is 0. Um, the net dividend per share. So I'm going to be calling the right thing. Please, it's the arrangement of the table that makes it look scattered. So the dividend as percentage, the net dividend per share is 1.4 for 2004. The sorry, the net earnings, I meant to say the net earnings per share, not net dividend. The net earnings per share is 1.4. The net dividend per share is 0.4, and the dividend as percentage of earnings is 60%. So, and the same thing goes for other ones. So for 2007, we can say that the net earnings per share is 1.3, net dividend per share is 0.95, and the dividend percentage is 73%. So doing this analysis, doing this analysis will help us to even know what we are doing. It will help us to say that, okay, you know what, I think so it will make it easy for us to calculate the EPS and DPS or any other share valuation calculation that we may want to pick or deduce from here. So now is to start with EPS. So for change in EPS, we say that 0.15 of 100%. 0.15 multiplied by 100. So that gives us 10.7. Hold on. No, sorry. 0.15 multiplied by 100 divided by net earnings. The net earnings being 1.4. So that gives us 10.7%. But for dividend per share, is going to be 0.16 multiplied by 100, but 0.16 divided by 0.84. So if you do the calculation, let me see if I can bring out my calculator. So if I do 0.16 divided by 0.84, do you see, multiplied by 100? That is approximately 19%. So that was how we derived our 19%. So during this period, we're saying that earnings per share have declined by 10.7%, while at the same time dividend per share has increased. So if you look at it initially, the earnings per share was what's it called now? The net earnings was 1.4. The net dividend was 0.84. The dividend percentage of earnings was 60. Yeah. So now in percentage it is now 10.7, while at the same time dividend per share has now increased by 19%, while for earnings per share it has decreased by 10.7%, because initially it was 0.15. Now we are saying it is 1.4. So let me continue. The payment ratio has increased from 60% in 2004 to 80% in 2008, and thus the proportion of earnings retained has fallen to 20%. It is assumed that the capital structure has not changed over the period. Then it can be seen that both actual earnings and returns on capital employed have declined over the period. One possible implication of this policy is that insufficient earnings have been retained to finance the investment required to at least maintain the rate of return on capital employed, it then means that the company is falling behind its competitors. It means that they are falling behind their competitors because their share price will not be able to compete effectively with other companies. It will not, they will not break even in the long run. And this is something that needs to be considered critically. Critically. So one possible implication of this policy is that insufficient earnings have been retained to finance the investment required to at least maintain the rate of return on capital employed. So okay, we've said that. So for the rate of return now, is to say that for the purpose of calculation, it is assumed that any new investment will earn a rate of return equivalent to that required by the shareholders, and that this will also be the level of return that is earned on existing investment for the foreseeable future. So it is further assumed that investors are indifferent as to whether they receive their returns in the form of dividend or as capital appreciation. But most times it depends on the investors that we're dealing with. Most of them will tell you that they want it as dividend because they don't really trust the management that the capital is going to appreciate even in the unforeseeable future. So they just want it, on the go. They want to get their dividend as the business is progressing. So for option one, the amount of dividend per share is ₦1 with no growth forecast. The rate of return required by shareholder is 15%. So the theoretical share price, and maybe for the purpose of this exam, it is also important we study our work very, very well. We cannot joke with work when it comes to SFM. Work is compulsory, is important. Work and black schools, all these theoretical X right price, we need to know them very, very well. So the amount of dividend per share is ₦1 with no growth forecast. The rate of return required by shareholders is 15%. So the theoretical share price can be estimated using using the dividend valuation model. Using the dividend valuation model. Now, K1, KE, I said K1, sorry, KE, which is the cost of equity, is equal to D1, which means dividend per share, bless my soul, dividend per share divided by PO, which means market price per share. And if you do the arithmetic, you are going to get your market price per share would be 15 kobo. 15 kobo. So going by that, that means 100% of the total sum will be paid as dividend. So for option 2, they said they are considering 4 options. And the second option is that in this case, 50% of the expected return is in the form of dividend and 50% as capital appreciation. So a numerical example will clarify that position, and the rate of growth of dividend may be expressed as G is equal to RB. R means required rate of return, while the B means proportion of the profit that is retained. So going by that, with dividend at 50 kobo per share, our growth R and B is what? 0.075, or what we can call 7.5%. So we have said that PO, which means our market price per share, can be denoted as dividend divided by R and R minus G. R meaning required, meaning our retained earnings minus the growth. So, of course, turning the formula around, we have something like D1 equals to DO into 1 plus G, and that gives us 7.17 kobo. 7.17 naira plus 50 kobo. So if we add that together, we have 7 naira 67 kobo cum dividend. When we hear cum dividend, it means that the dividend is inclusive after the dividend has been declared. If they say X dividend, that means the dividend has not been included. So you have to add the dividend. And our figure is cum dividend. It means that this 7.67 that we have on the screen, it includes dividend. That means dividend has been added to it before they came about that figure. So for option 3, in this case, 25% of the required of the expected return is paid in form of dividend, while 75% is retained. 25% of the expected return is paid in form of dividend, while 75 is retained in the business. So for this one, the growth will be 0.1125 and the market price will be 7.42 approximately. For option 4, so for option 4, in this case, for a share of 6.67, investors will need to believe that retained profits will be invested in projects yielding annual growth of 15% and that the share price will be at the same rate. So 100% of the expected return is provided in the form of capital appreciation under this option. So under this option, this is the fourth option. So what we are saying in essence is that we're going to present these 4 options to the shareholders, letting them know that these are the options that we have, and they are going to make decision. Remember that as finance directors, our own responsibility is to analyze and see what is obtainable in the market, put it in front of shareholders, let them see what the risk is, let them see what the opportunities are. When they are able to see all these things side by side, they can make their decision, and they know that whatever decision they are making is based on the fact that we have given them. So this is where we're going to call it an evening, and I believe that what we have discussed is useful in no small way to everyone. I want to say a very big thank you for your time. Thank you for staying live, and I wish you all the best in your forthcoming exam. Please, in case you have any questions, do well to drop it on our study challenge live on our study challenge platform on Telegram. That is where we are entertaining questions that pertains to study challenge. So if you put it on the live class, on the group, on the general group, and you are referring to the study challenge, we may not pick it easily. So put it on the study challenge live class, and we're going to pick your questions there and attend to them. I wish everyone all the very best. See you on induction dates. Thank you and have a good evening.